This is the Alhambra Investments Weekly Market Pulse with CEO Joe Calhoun. And Joe, I think the thing we have to start with today is last week's Fed meeting. Fed raised rates another 75 basis points, and Jerome Powell seems to be going around with his chest stuck out and being the economic tough guy. What do you think?
Yeah, look, first of all, I hate talking about the Fed because I think they get a lot more attention than they deserve. But they do have an impact on markets, and so we must pay attention. They did raise 75 basis points last week. That was expected. I think the unexpected part was maybe that they sound like they're going to be or going to try to be a little bit more aggressive on the rate hikes, get up to 4% by the end of the year. Kind of the way I read it was that you're going to get to 4 by the end of the year, and there's maybe another quarter point hike next year. But, I'm not really sure why the market reacts so strongly to these things. These guys make these projections all the time, and they're always wrong. So I don't know why people think they might get it right this time because they never do. But for whatever reason, people took them seriously. But I really think that the bigger problem was, as I said in the piece, I think Jerome Powell really gave a very poor performance at the press conference. Several of his answers to the questions that were posed to him, quite frankly, were idiotic. I just think he looked incompetent. And the market, may not, in the long run, it may not care what the Fed does, but in the short term, you need some confidence in the Fed, and I don't think there is any right now.
Well, it seems like at least Powell and maybe the Fed overall is trying to get into stock prices too, instead of just monetary policy. I mean, that seems like he's overstepping his bounds there.
Yeah, I highlighted some stuff from back in Greenspan's Rational Exuberance speech, which everybody knows about from 1998 and or was it 97? I don't remember exactly when it was, but December of 97, I guess it was. But anyway, that was the first time that the Fed ever really talked about asset prices and the need to watch asset prices as part of monetary policy. And I think that's a mistake, but it is what it is. That started the ball rolling in that direction. But Alan Greenspan was a hell of a lot better central banker than Jerome Powell. Jerome Powell, I don't think it can hold a candle to Alan Greenspan. I have a lot of problems with how Alan Greenspan played monetary policy over the years. Primarily, all of my complaints about him were about him and the market. The idea of the Fed put came from Greenspan, and there's a couple of incidents, I suppose, during his term that you could put that on. But bottom line is that Alan Greenspan was a hell of a central banker as far as setting policy in ways that were not disruptive to the economy. And I think that's really what the role of a central banker is to be unobtrusive. And as much as Alan Greenspan maybe was kind of a rock star in a way and able to attract attention, he was always very careful about what he said, especially in public. I remember there's this one instance in Congress where he said, if you understood what I said, I must not have been, I must have misspoke. So look, I think the thing that really, the big mistake here is communication policy, this idea that the Fed needs to tell everybody what they're going to do so they don't surprise anybody. I think that backs them in a corner, and I think that's exactly why we're in the situation we're in right now. Jerome Powell and the FOMC set out this schedule for winding down quantitative easing, and they stuck to it come hell or high water because they didn't want to deviate from it because they were afraid that would hurt their credibility. And in doing so, they continued to buy mortgage-backed securities all the way into April of this year when housing prices were going up at 20% a year. It made no freaking sense. And again, because they set out that schedule, they felt like they had to stick to it. And it was a mistake. It was a gigantic mistake. Alan Greenspan, they said that there are certain deliberations, certain things that the Fed does internally that do not need to be seen by the public. And in fact, if you do that, if you let those things out immediately, it will inhibit your ability to run monetary policy. And I think he has been proven correct time and time and time again. I'm not a big fan of Jerome Powell. I mean, I think he got himself I said in the piece, I think he did what he had to do when COVID hit. I also think the shutdowns were a mistake, but they were what they were. He had to deal with it, and he did. But to continue to do what they did at an emergency level for 2 years was just insane. And we're paying the price, and we paid the price in inflation. But the fact is, he's now conducting policy by looking backwards, looking at, he mentioned in the press conference something about trailing 3-month average core inflation. I said, really? You're looking at what happened over the last 3 months to figure out what to do in the future? There are so many things you can look at in the market that will give you a clue about where things are going to get some forward-looking idea of how to conduct monetary policy, but he doesn't do that. So I don't have any confidence in the man. I don't think anybody else does either.
Well, you mentioned housing and some surprises last week. I mean, with interest rates where they are, housing starts were up, mortgage applications were up, and to me, the real shocker, refi applications were up.
Yeah, I have to tell you, the thing with housing starts. Now, housing starts were up 10%, but permits were down. But the interesting thing is, look, you look at that housing starts number, it's an August number. Mortgage rates had come down a little bit from July at that point. So maybe people were trying to get in before things went off, rates went up again. I'm not sure. But when you look at mortgage applications last week, mortgage applications being up, now they're up from a very, very low level. Don't get me wrong. But it's like, oh my God, how, in the refi thing, it's like, who in the hell is refinancing their mortgage at 6 and change? I mean, why did they not? They had 2 years to refinance, at 3 or less. Why did they not refinance then? Who are these people and how dumb are they? I don't know. Listen, I could see, if I were younger in a different situation, I could see, hey, I've got a mortgage at 3. I want to do some upgrades on my home because I'm not selling the house because I'm not getting rid of that 3% mortgage. I'm going to be here for a long time. I could see taking out a home equity line or something, a home equity line of credit to pay for some upgrades or something. I could see that. It kind of makes sense. But to refi your entire mortgage, I can't imagine who's getting an advantage refiing at 6 1/4. But I guess they're out there.
Wow.
But I think the thing to take from that, more than anything, is that the economy can adjust to whatever level of rates exist. It takes time. And that's, I think, where the Fed is making a mistake here. They're trying to go so fast, and rate of change matters. If you move things very rapidly, people don't have time to adjust. And if they don't have time to adjust, they're going to pull back. They're going to do nothing because they're going to wait for you to be done. So I think that the rate of change is extraordinarily important. I don't think the Fed gets that. Look, if I were running the Fed right now, I'd be sitting here waiting for probably 6 months to see how what we've already done affects the economy, especially knowing that there are a number of, again, forward-looking indicators out there that indicate that inflation's already rolled over. If you look at money supply growth, anything, there are any number of things you could look at that indicate that inflation has already rolled over. So, pace matters. But like I said, the market and the economy can adjust to whatever level of rates exist.
Last thing I wanted you to talk about today, two other things that were up, the dollar and the 10-year yield. And I looked right before we started to record. I mean, the 10-year was just a touch over 375. Wow.
Yeah. Look, the trend's up. We've been talking about this for how long? Months, years. The trend of the dollar and the 10-year is up. Which, by the way, the trend of the 10-year being up as it is, people keep talking about recession. And the same thing is true of short-term rates, whether you're looking at the 2-year or the 3-month bill. Recession is not going to come while rates are still rising, or at least that would be entirely unusual if you look at history. There have been times in the past where short-term rates peaked right at the onset of recession. But there are none that I know of where the recession hit and rates kept going up, short-term rates kept going up. So the idea that rates are still going up, and that we're on the verge of recession, those things don't work together. I find it very interesting, again, looking at these short-term rates markets. This morning, in the Eurodollar market, the March contract and the June contract traded at the same price. Now, it's interesting because what that indicates is that the date for the peak in rates is being pushed out. we were all the way back to the end of this year, 2022. When you look at the futures curve, what you're looking at is there's an inflection point where rates go up until some point in the future in the Eurodollars curve, they start to go down again. Well, if you go back to the spring, then that inflection point was in the fall of 2023. It got pushed all the way back to like January of 2023 or even December of 2022, depending on how you read the curve. Now it's back to March, between March and June. And if this flips where June is actually at a lower price than March, then you're looking at a peak in rates sometime after June of next year. Recession is not a near-term event, at least not according to that. The economy is slowing. It's been stagnant this year. I don't find that surprising. It's exactly what we expected. Good side of the economy slowing down. The services side of the economy is still recovering. You get to zero that way. We got the Chicago Fed National Activity Index this morning. Guess where it was? Zero. What does that mean? It means we're growing at trend. Now, okay, trend's 2%. Maybe we're not growing at 2%, but we're probably somewhat below that. But it's interesting. The actual number, the 1 month number was 0, and the 3 month average was 0 as I'm telling you, that just tells you that, you're at trend. We're not in a contraction. We're not in a recession right now. And I find it very interesting. Until those rates peak, I don't think you got to be worried too much about recession. Now, the pace of change, the rate of change on rates is very rapid. And I would say that oftentimes you get these kind of blow off moves like this. And I suspect that's where we are with rates. They've been going up very, very rapidly. That rate of change is usually not sustainable. It also means too, usually when you have a rate of change that way on the way up, you get a similar rate of change on the way down. So let's see where we go.